We're now 2 minutes away from the CPI inflation report. The projections are CPI 0.2% month over month. My projection is 0.1% month over month. CPI X energy and food month over month 0.4. We are projecting myself. I'm projecting 0.3%. So a 0.1% below both of those are my projections for the month over month figures. The prior report was zero point 0.4 and 0.5, so we'd be coming down with a 0.2 and 0.4 on both of those. Year over year, we're going to see a nice big decline moving from a year over year of 6% to 5.1%, which is a fantastic drop down. However, core is expected to actually tick up slightly from 5.5 to 5.6. So we'll be getting that data within about the next 100 seconds here. We're very excited. This is a big moment. This is absolutely going to give us guidance on whether or not the Federal Reserve is expected to raise interest rates by either 25 basis points again or pause. This is a very big deal. Right now, the expiration of the coupon code is also set for today. We'll be raising prices on that tonight. Now, let's go ahead and look at the rate monitor as we get into the next 60 seconds here. So the rate monitor puts us at about a 74.7% chance of getting a 25 basis point hike next. The Federal Reserve does appear to be split on this. 10-year treasuries have come down. So that is a loosening of financial conditions, though mortgage rates do still remain high. At about 6.9% for the 30-year mortgage as credit spreads are widening. So that's actually a weird phenomenon where you can actually see 10-year treasury yields come down, but financial conditions remain tight and keep mortgage rates high for real estate. However, real estate inventory has been so low, we have not actually seen any kind of major pain just yet in real estate. Okay, we are now just seconds away from the CPI data. Within the next 10, 20 seconds here, we'll have the CPI data. We'll be going through the report as well. This is a big moment. Again, we're looking for, a market is looking for 0.2 and 0.4. So drum roll and stay tuned. Remember, check out that coupon code. Oh my God, it's 0.1 month over month. I was right. However, the core was 0.4. So core matches expectation, 0.1 on the month over month. Let's freaking go. Let's go. Year over year comes in a little soft as well at 5% as opposed to 5.1. Core matches expectations at 5.6. So expectations matched on core month over month and year over year. However, on non-core, we got that 0.1% and that 5% year over year. That's absolutely fantastic. That's a sign of not a devastatingly weakening economy. It's not a sign that we're in this crazy recession, that everything is falling off a cliff. It is a fantastic sign that inflation is continuing to trend down upon expectations. We're not getting any kind of crazy reanimation of inflation here, even though outside of expectations, we're not, and that's a big issue, right? We were worried that maybe in this report we would see some kind of massive increase in services inflation or something. Keep in mind, housing inflation is still keeping these numbers really elevated. So we're going to take a look at all of that data here. But this is a fantastic report so far based on the headline numbers here. We're going to get Wall Street reactions here as well, but let's get into both the report and Wall Street expectations, or Wall Street reactions, rather. So let's jump into the actual report. And here we go. This is the actual report on screen now. Let's see what we got here. CPI rises 0.1%. That was my expectation. There were only 4 economists out of all of them surveyed that had that expectation. Over 40 of them interviewed by Bloomberg were looking at 0.2. There's that 0.4%. Kevin was off on that one by 1% over the last 12 months. There's that 5%. Okay, let's go into the actual granular data here. So it looks like, okay, here we go. The index for shelter was by far the largest contributor to the monthly increase. That's good. That's actually a good thing because we do expect that to come down for rents, which is good. However, we still haven't seen that come through. So there is that risk that what if that rental deflation never comes through? That would be a big problem, right? But we still expect it to come down. Even Jerome Powell just a few weeks ago reiterated that this will be coming down. We do have stock futures jumping. The 2-year treasury yields are tumbling right now. This is fantastic. It looks like real average hourly earnings fall 0.7% year over year. No wage price spiral. This is fantastic. This is really good, and this is not like so bad to where all of a sudden we're looking at it going, oh my gosh, we're at the end of the world in terms of depression or whatever. Let's see here, shelter. What's shelter? Shelter, there it is. Look at that, shelter coming in at 0.6%. for the March numbers over here. That's telling you, remember, shelter was actually upweighted in the CPI reweightings to about a 34% weight. Transportation services, my goodness, coming in at 1.4%. That's high. Medical care is not reinflating. That's very good. Medical care commodities, however, a little bit of a commodities bump over here. Not so good, 0.6%. It's about 7.2% annualized. Used cars coming in negative 0.9%. That's good. New vehicles coming in at 0.4%. Let's get a little bit more of a detailed chart here while I also get some more reaction here. Housing cost was the biggest contributor. Wall Street reacting to this. We're going to get the detailed chart here. Get a little bit more numbers here while I pull this up. Remember, CPI is, this is going to be a crazy day. I'm getting so many emails for bundle coupons already this morning because on expiration day, we go through all the emails for everybody who wants a bundle coupon. Email us at kevin@meetkevin.com. Let's go through the actual detailed set here. If you want a bundle code as well, you can email. I want to go right to the end in services. This is the most important side. Okay, here we go. Personal services. Thank freaking God. Look at that, 0.2%. Let's go. Let's go. No reanimation of inflation at services. Really important. 0.2%. That's 2.4% year over year. That's great. Personal care services. However, you have personal services overall still hot, but kind of aligned with trend here at about 6%. So still a little high there, but not running away. Kind of like last month, we had that 1.1%. That was not great. Legal services finally reducing to about 0.2. Last month we were a little high. Funeral popped up a little. Financial services finally coming down a little bit here, kind of matching that previous trend coming down from these prior higher numbers here. We want to see these services really stable. We don't want to see runaway inflation here. Education services annualized at 3.6%. Postage at 1.2% annualized. That's great. Telephone services going negative. Great. Fantastic. Photography is going negative. Okay. Well, sorry, photographers. Okay, here we go. Thank goodness. Okay, this is one place where there could have been lingering inflation, and that is in pet supply, pet foods, you name it. Thankfully for pet services, including vet services, 0.5%. That's more stable at 6%. That's good. Don't want to see runaway there. Video and audio services, still a little hot over here at 0.9. Rec services coming in flat, good. Airfares, oh my Lord. That's not so great. Airfares at 4%. It's shocking to me how these airlines can continue to pass on these high prices. That's pretty remarkable. Now, fortunately, it's just a 0.6% weighting, but that's still pretty high. It is down from last month, but we'd like to see that negative. Motor vehicle insurance, 1.2% for the month. That's still way too high. Warren Buffett was just talking about how insurance is actually helped by inflation because they can bring in more float, which then they can invest. So Warren Buffett actually cheering inflation for insurance. Not something we want to hear, obviously. Car and truck rentals down 3.8%. Good. Transportation services still hot, though. Health insurance, thank goodness. Look at those drops. Across the board drops here in medical, basically services via insurance. Hospital and related services also negative. Good. Medical care services overall negative. Good trend here of services disinflation. We like seeing this. This falls right into the argument that inflation can end up proving to be transitory, especially once we actually get the decline. Oh, it's happening. Oh, it's starting. Look at this. We're getting the rollover here somewhat. We're finally starting to see it. Rent of primary residence finally coming in at 0.5%, back to what we've seen previously. Finally seeing the rent of shelter number overall back to 0.6 off of those really high numbers like that 0.8, 0.7. I think we're starting to lap some of the year-over-year numbers, and month-over-month, we're starting to see a little bit of weakness. However, lodging away from homes, so hotels, still explosive growth here in the numbers. So still a little expensive. However, rent of your home is going to be a substantially larger contributor. You can see that here, owners equivalent rents coming in at 0.5%. Let me quickly see what that 0.4% number is. That is our fourth number here. Yeah, that is the unadjusted Feb to March number. So let's get back over here. We're just going to ignore this right here because that's the Feb to March number. Really, you're going to be looking over here. That's the last 3-month trend, and we finally see that moving down a little. Finally, that's actually really good. So happy to hear this. This is good. Then you've got, what do we have here? We've got personal care products. Wow, that's still a little expensive. A little expensive over here on some of those personal care services. Services less energy, 0.4%. That's okay. Goods Goods are still deflating. Well, not I shouldn't say 0.5% is deflating, but other goods sitting at 0.5%, led by cigarettes, actually. Alcoholic beverages away from home, 0.3%. Look at this. Alcohol starting to really come in low in the last 2 months here, deflating, probably because Kevin stopped drinking alcohol. Sorry, I was contributing to the industry too much. And so now I've stopped, but at least we're causing deflation, which is good. So that's a good thing. We've got education and communication commodities. Good, nice negatives over here. We have toys. Toys still hot. That's surprising at 0.7%. Sporting goods, negative 0.6%. Pet and pet products. See, look at this. Still hot over here at pet and pet products. That's good for companies like Petco. They're still able to pass on. They still have pricing power. We don't know how long that'll last, though, given the flat household formations. Medical care commodities coming in at 0.6. Recreation commodities, 0.2. Here we go. New vehicles coming in at 0.4%. Transportation, less motor fuels, 0%. New cars, 0.6. New trucks, 0.3. Used vehicles, negative 0.9. So you're still getting that compression where you've got new coming up in price and used coming down in price. This is fantastic. We're going to speculate on the Federal Reserve in just a moment. Apparel coming in at 0.3%, finally softening after that initially warm winter that we got in January and February, and you started seeing some more of those spring sales pushed forward, which are generally higher or more likely to be full price sales. Tools and hardware coming in at just 0.2%, really nicely off that 2.7 from last month. Fantastic. Household furnishings coming in at 0.4%, still a little high. Appliances for some reason at 0.7, odd. Those are going to be like your coffee makers, whereas major appliances are still negative. They've been negative for a while, those more durable goods. And then, of course, if we look at foods, we have a lot more volatility over here. Food, however, look at that. Food inflation, 0%. Now, who actually believes that? I don't know. Food's been so expensive. You go to restaurants, it's just insane right now. How's coffee doing? Coffee coming in at negative 0.4%. Good. I need some. Energy had a nice big drop over here at 3.5%. All right, let's get a little bit more of the commentary here from Wall Street, and then let's speculate on the Federal Reserve, shall we? Okay, so chief economist at Wells Fargo tells Bloomberg TV that while there are pockets of optimism in today's print, inflation is still far from 2%. I'm so tired of people saying this. I really think they are just like bears who don't understand that inflation just has to trend down to 2% throughout the rest of the decade, and it's fine. Of course, it's not going to go, oh, we're at 2%. No shit, Sherlock. It's just, I don't think people realize the Fed is going to pull fate out of the genie, out of the magic hat. The bunny rabbit that comes out is going to be fate. Flexible, average inflation targeting. The Federal Reserve uses policies known as opportunistic disinflation to make sure that inflation trends down over time. Obviously, inflation is too hot at 5% year over year, and that's why we're seeing rate increases to accelerate that disinflation. But does the Federal Reserve really want to destroy the economy in order to get inflation down as long as it is trending down? No, of course not. So could the case be made for a pause here? Yes. Do I think this is enough deflation or disinflation, should I say, to see a pause? Probably not. I would probably go for a 25 basis point hike, and that's based on probably the Atlanta Fed Now real GDP estimate. That is, real GDP growth right now is still expected to be about 2%. That means we have plenty of room for the Federal Reserve to increase their tightness on markets. I also think there is a large psychological effect to making sure that inflation is indeed or proves to be transitory. I know everybody makes fun of the Federal Reserve, obviously, for saying that because they've been wrong for so long. And it's likely that they could be wrong again. But when we take a look at this right here, this is the Atlanta real GDP Fed Now estimate released 2 days ago, which is 2 days before the expiration of the coupon code. Given that today is the 12th, prices are going to be going up tonight. If you want to bundle up for any of those programs, whether it's 0 to Millionaire, real estate investing, stocks and psychology of money, elite hustlers, make more money as an entrepreneur and employee, learn about insurances, liabilities, LLC, you name it, everything linked down below. Check that out. Obviously, this video isn't personalized financial advice, but I am a licensed financial advisor and run an ETF and have other affiliate links you can learn more about at meetkevin.com, some of which are sponsored. But let's go ahead and look at this GDP link here. What do we have? Latest estimate, 2.2%. What's important for you to know about this right here is that this is a tool for the Federal Reserve to say, hey, look, if GDP is still trending 2% in our last summary of economic projections, we were looking at GDP at coming in at 0.5% by the end of the year. We still have leeway to actually raise interest rates. And I think there's a psychological element to the Fed getting to 5%. So I think while the odds of a 50 basis point hike are going to fall as a result of this, I do believe that we are going to see the Federal Reserve end up going for a 25 basis point hike. I actually think that is a good thing. If the Fed goes 25, it's a sign that we are further away from recession than people think, which is fantastic. 10-year Treasury yields are falling about 7 basis points. We're sitting at about 3.36 right now. This is reiterating that inflation is trending towards potentially being transitory. Again, I realize that is offensive to some people to say that word because the Fed has been wrong so long. 2-year Treasury yields now falling about 14 basis points, sitting at 3.91. However, the fact of the matter is, if in a year from now inflation is potentially under target, we will look back and say, yes, it ended up being transitory. It just took time. It took patience. And that's probably the biggest thing we could learn from this entire cycle, is that this whole cycle tends to take a lot of patience. Now, what I really want to be clear about is what Wall Street is reacting with. So right now, it does look like futures are up about 65 basis points on the Dow, 82 basis points on the S&P, and 107 basis points, 1.07% on the NASDAQ. It looks like Powell's favorite inflation measure as of late is the core services in excluding housing. Came in at 0.4%. That is down from the 0.5% in February, but it is still slightly elevated. That is still a problem. So core services, excluding housing, is not running away. That's a good sign. It's not runaway inflation. However, we are starting to see it trend down. It's just not low enough yet. That's okay. We know that. It takes time for it to trend down. The price of eggs tumbled the most since 1987, down 10.9% from Taylor Swift's, actually down more, probably down like 50% from when Taylor Swift said she was going to help get egg prices down. Obviously, that's a joke. Rates market is reacting to this weaker report here. However, we have let's see here, again, core services ex housing up 0.4%, not fantastic, but again, still trending down. So that's called the super core level, which does exclude housing, just so we can really narrow into services. Let's see here. Fed futures pricing in still rate cuts towards the end of the year from the Federal Reserve. Still sitting at expectations, though, let me look at if we can get an adjustment on the terminal rate here. And then let's also look at the 5-year break even. Stand by for that data. 5-year break even data. Let's see what we have. And then let's also look at if the terminal rate has started moving. So slight inflection down coming on the 5-year break even for inflation expectations. In terms of the Fed's terminal rate, we are looking at financial conditions, by the way, also coming down, but you would expect that. Less financial tightness given lower rates here. Waiting for this terminal rate to load. Terminal rate's still pricing at 4.99%. No big movement here. So still looking at that 25 BP hike, but it's becoming clear as day that we're probably going to be at an end of the Federal Reserve's hiking regime once they get to an even 5%. I do again think that is a psychological level that they are going to get to, and I am not concerned about a 25 BP hike. Do keep in mind later today, the Federal Reserve minutes come out from the prior meeting. Bond market is still pricing in 17 basis points of hikes. That is leaning towards 25. Remember, what they basically do is they take the average of how much the bond market is pricing in 0 and how much the bond market is pricing in 25. That average, or the midpoint would be 12.5 basis points, right? The market right now is pricing in 17 basis points, which again leans us towards a 25 BP. I agree with that. I actually think it is good. Get to 5% and be done. Markets are, let's see here, core figure coming in at 0.1% was fantastic. That actually matched my estimate perfectly, which is very exciting. And so we're looking at actual market reactions here. I would expect that this very much aligns again with the Nike swoosh theory. If you haven't been watching sort of daily where I've been talking about the Nike swoosh, that's okay. I still love you. But let me make it clear. I think the Nike swoosh is basically where we have a sharp decline in prices, which we've had over 2012, and then a Nike swoosh style recovery. Let's show you what that would look like. Briefly, this is pretty simple. What a Nike swoosh potentially looks like is you have a sharp decline, which we had throughout 2012. You bottom out in around October, maybe in some stocks you bottom out in July, in December, depending on the type of stock, and then you have this very long, drawn out, dare I say, Nike swoosh that potentially takes really just the next 10 years, not necessarily to get to prior levels, but basically the Nike swoosh just continues for the next 10 years. We really start a new bull market era. However, in the meantime, you end up with a lot of this, a lot of volatility that creates a lot of nervousness and pessimism. Each one of these drawdowns will be very painful. And people will question: Is inflation transitory? Did the Fed over tighten? How terrible is the recession going to be? Who knows? But my thesis is look for pricing power stocks. I talk about those obviously, and I put my money where my mouth is. You can learn more about those at meetkevin.com. You can see the links not only for the courses with trade alerts or the ETF or the affiliate links linked down below. But this gives us CPI, a fantastic read on CPI. Very, very excited about this. So this is great news. It is a little bit of a shocker that it came in low, but jump back on over to Warren Buffett.